Hello everyone, and thanks for joining us during this extreme environment for the April edition of the Perpetual Investments Multi-Asset webinar. My name is Jason Hunt, and today I'm joined by Michael O'Day, who is Perpetual's Head of Multi-Asset, and Matt Sherwood, who is Head of Investment Strategy for our multi-asset funds. In the webinar, Matt and Michael share their perspectives on the most recent developments of the continuously evolving COVID-19 situation and the related implications on financial markets, the global economy, and policy responses. Importantly, against this backdrop, Michael will share the portfolio performance, relative performance, and portfolio positioning of the Perpetual Diversified Real Return Fund, before concluding by sharing his views on where to from here. I would now like to welcome and hand over to your first speaker today, Matt Sherwood.
Thanks very much, Jason. Well, in recent decades, I'd argue that financial markets have been subjected to what are labelled once-in-a-century event about every 5 years. But unlike 2001 and 2008, I would argue that the 2020 virus crisis has come pretty much out of nowhere. And investors are quite confused, not about what's going on, but what they should be looking at. One moment they're looking or they're seeing plunging equity markets. Next they hear oil prices are crashing 70% in 2.5 months. Then the Central Bank of New Zealand's doing QE. And after that, they're looking at exponential growth rates of pandemics. So there's a lot of information out there. And I believe that things are complicated, not because there's a shock that we haven't seen before, but rather because there are 4 simultaneous shocks pressuring the global system. And they are all feeding off each other. So today I will briefly explain each shock. We'll have a look at the policy response and the macro outlook, and then I'll explain why I think there's more downside risks for markets in the period ahead. Now, the first shock was simply the global economy. History demonstrates conclusively that recessions occur when stresses hit vulnerabilities. And whilst the recently ended 2009 to 2020 cycle has been the longest in history, it was always also the weakest in history, as there was a lot of balance sheet repair that was required after the GFC. To facilitate this, central banks cut rates to zero and undertook $14 trillion worth of asset purchases. And on the left, we can see that all the corporate deleveraging that occurred post-2009 was unwound in the 6 years to 2019. However, one major difference is that half the debt that was written in the past 6 years was at the lowest quality investment grade rating, namely the BBB space. Now that's fine as long as corporations can make their coupon payments. But coupon payments are not only paid when things are hunky-dory. They have to be made during periods of stress. And in the global system, profits are now incredibly levered. So you need a lot of debt to facilitate even modest revenue and earnings growth. And this means that every economic downturn runs the risk of turning into a financial crisis. Now in 2019, cost pressures saw global earnings growth slide to a 10-year low, as we can see on the right. And this year, it may decline upwards another 40 or 50%. And that is likely to expose fault lines not only in business operating models, but more importantly in credit markets. The second shock is the COVID-19 health shock. And there is now around 1.5 million cases of the virus and around 100,000 deaths. And the virus is now in all but 15 countries in the world. Now, much like wars, health pandemics are characterized by having very fat tail risks. And we know that so far the global impact has been fast and severe. And on the macro front, much like war times, something that is fast and destructive causes much more damage than something that is grinding and slow. A history of pandemics shows us that they tend to come in multiple waves. And the first wave was in China, which peaked in mid-February this year. Then it spread to Europe, who has by far the most cases, and now it's gone into the United States, which has the most cases for an individual country. The left chart shows that China flattened its curve by closing down its economy and implementing social isolation. But this strategy comes at a massive economic cost, and the financial problems here have two main prongs. Firstly, the lockdowns are devastating for revenue growth and personal income, which services the private debt surge that we saw in the last slide. And secondly, the fiscal relief needed for these two sectors are on an unimaginably large scale, something similar to what we see generally in war times. Hence, COVID-19 has provided a link between the economy's two major stress points from the last slide, that is record high debt and structurally weak income growth. I think people may be getting too much comfort from the flattening the curve mantra, in the sense that small percentage changes work well with small bases like Australia has. But when the base is large, like in the United States, you need to both flatten the percentage changes of new cases as well as the daily numbers if we're going to understand and manage the pressure on the health system. The third shock is in the energy markets, and I think people are massively underestimating the impact here. Falls in crude prices below break-even levels caused the blowout in credit spreads that we saw in March and April. Russia knows that it has amongst the cheapest break-even costs of production for oil at $42 a barrel, which is half what Saudi Arabia's is. So the world is now producing more and more oil at a time when demand is cratering lower, as the global economy is in recession. If oil prices being below break-even levels are sustained, high-cost producers will lose money and raise the risk that some firms won't be able to meet their credit obligations. This is a large risk, particularly as real oil prices are around the lowest level in 50 years, as we can see in the gold line in this chart. And that means rates of return are low in this capital-intensive sector, and hence downgrades and credit defaults are likely ahead as creditworthiness is declining quite sharply. While lower oil prices are good for consumers, there was a similar decline as we can see in the blue line in 2015 and 16, and this was unambiguously negative for the global economy, as it weighs heavily on investment, equity earnings and credit spreads, and 2020 won't see any exception to those rules. The net of these three shocks has created a fourth, which has been the largest risk market losses for this cycle. But what has been amazing in 2020 for equities on the left has been the speed of the market decline. It took us 7 months after the 2007 market peak to sell off 30%. But in 2020, it took us only 32 days. And the damage, of course, has not been limited to equities, as the largest blowout in spreads in the US, European and emerging markets have created the largest credit market losses since 2009. Some are saying that we've seen the market trough in both equities and credit, but the longer the economic closure and the deeper the growth hole is ahead of us, the more likely second and third round effects could be triggered. Sadly, we don't know all the stress points, and there will be undoubtedly fault lines which are just not visible at present. As such, I think the risk is the market is underestimating the nature, the size, and the duration of these four combined shocks. In the end, I think it would be remarkable if we head into the largest growth contraction ever, yet the financial market dislocation is all over before we have seen one recessed piece of economic data. In the end, I just do not believe that such an environment is feasible. Whilst the private sector and financial markets are stressed, the policy response has started. But the key question is whether the policy makers around the world have brought a knife to a gunfight. You can see on the left that monetary policy has provided less support than in 2008, as we started the 2020 crisis with negative real interest rates and large central bank balance sheets already in place. 2020 global monetary support totals around 1.5 percentage points of global GDP. Record high debt and falling income makes it harder to solve the base issue by just pumping liquidity into the global system. And simply saying to economic agents, just draw down on this cheap debt until things improve next month or next quarter. The issue to me is not liquidity, it is the impact of the lockdowns causing stress on revenue and personal income, which makes servicing record high debt more arduous. And a lot of debt this cycle has been issued outside the banking sector. So the central bank's liquidity solution is ideal if there are only banks and there is no debt. Fortunately, the fiscal response has been much larger, and at 2.5% of global GDP and rising, it's around the total fiscal stimulus for 2008 and 2009 combined. Whilst it's increasingly common for 2020 budget deficits to be over 10% of GDP, a lot of this is actually loan guarantees, which are not what I would call GDP effects. So the combined monetary and fiscal impulse in 2020 totals around 4% of global GDP, which quite clearly is a lot. Of course, this won't prevent the worst quarterly global downturn in history, but it does help mitigate the downturn, and hopefully it will limit the supply side rigidities in getting things moving again once COVID-19 has actually passed. This chart provides the quarterly growth profiles for the major economies, and I believe 2020 is going to be characterized by a rolling global recession that began in Asia and Europe in the March quarter, then will be carried on by Europe and the US in June, and then hopefully things will stabilize with a slow recovery into the year's end, which will then strengthen in 2021. In the end, that is the best case scenario that I think we can hope for. Importantly, growth declines of 9 to 10% in a quarter are larger than anything we have seen in the US, Europe, Japan, China, and Australia in history. We didn't see it in the GFC, nor in the Great Depression. Normally, in a recession, growth comes down a couple of percentage points only from start to finish over about 18 months. But this, of course, the growth decline this time will be 10% in a few quarters. And the deeper the decline, the more likely we can get aftershocks and raise the risk of negative quarters in September. Regardless of Q3 growth this year, 2020 and 2021 will see net falling economic output, not only in the US and Europe, but also in Australia. One of the keys to the downturns and the timing of the recovery is the labour market. So in this chart, there's obviously a lot of numbers, but there's really just two bits of data here. What we have is the change in jobs on the horizontal axis in the blue up the top, and of course the size of the labour markets on the vertical axis in the red. So in the end, if Australia, for example, lost 1 million jobs, but the participation rate and the size of the labour market didn't change, we'd be expecting unemployment in Australia to hit around 12.5%. In the end, I think unemployment rates in double-digit territory is what to be expected, not only in Australia, but also in the US, where we suspect unemployment within the June quarter will get to about 12 to 15%. So obviously there's a very large labour market dislocation, which has an impact on earnings, economic growth, and of course on earnings performance. An economy's GDP is the same concept as a firm's revenue, and a 2.5% decline in global GDP in 2020 is equivalent to a circa 10% decline in revenue growth and around a 40 to 50% decline in earnings. And that's before firms write off assets. At the moment, consensus earnings growth for 2020 is 0. So there may be, a rush for analysts to downgrade numbers. We can see on the left, my earnings model fell 20% in 1 month, and that won't be the end of it. And I think markets may be generally shocked by the size of the corporate deterioration. There are many data points to support the notion of a large drop in corporate earnings, including the historic relationship between GDP and global earnings growth. And another is the relationship between the Global Purchasing Manager Index on the right. This is already suggesting declines of around 35%. But if the new consensus among macro analysts between 2 and 3.5% GDP hit are right, then that's equivalent to a global composite PMI index on the right in about the low 30s, which is around 50% decline in global earnings growth. Another risk point for the market and hence the economy is that one of its support bases this cycle has dissipated, and that is the level of share buybacks, which have underpinned a reasonable amount of the total US share market's return for this cycle. It is interesting to note that the use of buybacks was declining at the end of 2019. That is, before any of the four crises mentioned at the start of this presentation had become evident. By way of background, buybacks are funded through either the issuance of credit securities or funded out of profits. And both of these channels are set to decline sharply, and therefore the amount of buybacks will plummet, just like it did in 2008 and 2009. It's also important to remember that nearly all global downturns since World War II have been driven by falling demand, as shocks contract manufacturing activity, which slowly spills over into other parts of the economy and then the labour market. In contrast, the 2020 recession has been driven by closures of the supply side of the economy, sparking a large services sector contraction, which has spilled into the labour market in a matter of a few weeks. I think a lot of the building blocks for the economy and financial markets over the past 40 years are under a cloud of uncertainty. Of most significance is that if we can sustain the coordination between monetary and fiscal policy, it will end the period of secular stagnation. The most prominent feature of secular stagnation has been the decline in the neutral interest rate. And if this period ends, it will mean that next cycle interest rates will rise. Another interesting trait is that the 2020 supply shock will represent another structural headwind to globalisation, as there is likely to be a renewed focus towards a country first and a renewed call for simplified supply chains. This will raise business costs, lower margins, and weigh on earnings growth, as will the trend for firms to move away from just-in-time management processing, meaning that more working capital will be needed to carry more inventory on shelves, given the supply shortages caused by China's closure. I also think that with rates and huge central bank balance sheets likely to be permanent parts of the policy landscape, central banks' next layer of support will be implementing some form of direct funding of government stimulus through modern monetary theorem. But monetary policy's central role in stabilising the risks that we have seen over the past 40 years will pretty much be handed over to fiscal policy, which will be funded through higher taxes and central bank money printing. In addition, I think there will be a renewed push for corporates to deleverage their balance sheets, which will weigh on earnings per share, and the changing demographics will usher in an investment environment which focuses on risk management more than return management, as investors seek to protect their nest egg in retirement or even approaching retirement. Okay, I'll quickly just sum up before handing over to Michael. In essence, there are multiple stress points out there, an unprecedented growth hole, and a whole bunch of unknowns. So I see three potential paths forward. Firstly, there is the fast solution with a vaccine for COVID-19 being found, and this would have to be out of an existing drug. If that occurs and policy, does enough of a job to paper over the cracks in the financial system, we all take a deep breath and the game continues beyond 40 years. I give that path about a 15% probability. A second alternative is that if COVID-19 crisis leads to helicopters, or I should say sustained fiscal and monetary policy coordination, I would guess it would end secular stagnation. The associated rise in interest rates will occur in an environment characterised by 1, higher inflation, 2, lower profit margins as less use of both supply chains globally and just-in-time inventory management leads to higher costs. And thirdly, there'll be an unwinding of the trends which supported high economic growth, such as factors like low savings rates, low taxes, and high leverage, all potentially set to reverse. This will probably end the process of the Great Moderation and set up an environment with more volatile GDP and earnings growth, as well as, more pressure on corporate bottom lines. I give that a 70% probabilities. A third option is simply that the world turns Japanese, with growth, interest rates and inflation all close to zero. Here, equities would underperform a lot of asset classes and markets will be captured in a broad side trend over a decade or beyond. I give this a 15% probability. In the end, supply shocks always end in people questioning the status quo, and it makes for a different and more challenging 10 years ahead, as most of the factors which have underpinned risk-return behaviour for the past 40 years are likely to change. And that means a new world, a more risky world and a lower returning world in which risk management will be the new mantra that investors and economic agents live their lives by. So what does well in a stagflationary environment? Well, the last time we saw such an environment was the 1970s, which was a decade of great and protracted inflation, monetary instability, large budget and trade deficits, wages and price controls, OPEC-induced spikes in oil prices, Watergate and the Soviet invasion of Afghanistan. Now, obviously, some of those won't be repeated in the coming decade, but the winners of the 1970s, from an asset class perspective, were value stocks as yield curves steepen, small cap and energy stocks, as well as commodities and property, both listed and unlisted. The losers, on the whole, were growth stocks, large cap, tech and utilities. However, I doubt that sectors such as energy and banks on the right will outperform in this decade, given the excess capacity and the deleveraging that is ahead of us all. Okay, well, that's it from me. So I will say thanks for your time, and I'm going to hand over to Michael. Thanks very much.
Thanks very much, Matt. At this stage of the presentation, I'll cover the diversified real return funds performance, including relative performance, how the funds are being positioned, and then our perspective of where things are headed. The real return fund was down 2.3% net of fees for the 3 months to the end of March, which brings the 1-year performance to 0.9% and the 5-year performance to 3.1% per annum. In comparison, the S&P ASX 300 Accumulation Index produced a return of minus 23.4% over 3 months. The Real Return Fund has now outperformed Australian equities across all time periods, and I'll address the since inception performance in a couple of slides' time. I often speak about the role of fund as maintaining participation during a bull market while protecting on the downside, particularly during bear markets. And last year, for the calendar year, the Real Return Fund produced an 8% gross of fee return in what was a very strongly performing market, but we raised concerns about the underlying dynamics. The return from equities was due to a valuation expansion, while underlying earnings growth was declining, and leading economic indicators were pointing to weaker economic growth. The Fed cut interest rates in the second half of the year, and US employment showed signs of strength, and equities continued to perform well. In the last webinar in February, I noted the importance of balancing returns with risk management, and I highlighted that the ASX had experienced 4 periods of time when it had sold off by more than 10%. In comparison, the Real Return Fund had drawdowns of less than 20% in each of those sell-offs. Well, I've updated that slide to include the COVID-19 sell-off, but the story hasn't changed. Again, the Real Return Fund has shown very strong signs of downside protection. Turning to performance attribution over the quarter, and looking back at the December quarter, that was primarily driven by the return-seeking portfolio and the downside protection strategies detracted value, particularly our exposure to the US dollar. Well, in the March quarter, the tables were turned, with the return-seeking detracting 6.3%, with every asset class under the return-seeking category detracting value, with the exception of US credit and listed property. We added an exposure to investment grade and high yield US credit and we also added listed property after the initial lows were reached. And that meant that we participated in the bounce in each of these asset classes, and so they contributed to returns over the quarter. The downside protection strategy worked well to offset some of these losses, with the US dollar contributing 1.5%, and the equity put options also added 70 basis points. Inflation protection also contributed positively, with gold adding 50 basis points and unlisted property also adding to returns. Now, recently there's been a lot of attention placed on unlisted exposures as super funds, who have up to 40% of unlisted exposures in their portfolios. Within the Real Return Fund, we have a 5% allocation to unlisted industrial property, which hasn't experienced the same headwinds that office and retail property has faced. The fund has a 98% occupancy rate with very long-term leases. In fact, the weighted average lease expiry is over 10 years. And the major tenants are consumer staple companies like food retailers such as Coles and Woolworths. And other tenants include online retailers who are actually benefiting from online trading. Now, when this fund was put into the portfolio, it was a deliberate strategy to avoid retail and office sectors because we were looking to increase the diversification of the portfolio. And we felt strongly that the industrial sector was far less economically sensitive than the other two property sectors. Now, next is the diversifying opportunity strategies, and that added 72 basis points to returns, with FX outside of our core US dollar exposure adding 194 basis points. Now, perpetual stock selection detracted value during the quarter, but I would expect that balance sheet quality is going to be a major driver of who survives this period and who can position themselves for the future. And this is a significant focus of the equities team. So what has our focus on risk management meant over the longer term? Here are 4 bands showing the performance of CPI plus 2% per annum through to CPI plus 5% per annum. Cash has been the weakest performer since October 2010 when the Real Return Fund was launched. The Australian Composite Bond Index has produced returns of around CPI plus 3.5% per annum. But looking forward, this seems very hard to achieve again, given that bond yields are now, the 10-year bond yield is now less than 1%. Australian equities were doing exceedingly well before the COVID-19 sell-off, but since then it has dropped to around the inflation plus 3% per annum level. In comparison, the Diversified Real Return Fund has performed above the Composite Bond Index, and it's now outperformed Australian equities since its inception, but has just slipped below its inflation plus 5% per annum target. Now, previously I've highlighted 3 ways a real return fund could be used in portfolios. The first 2 is for advisors who want to increase or de-risk risk within the portfolio without the downside risk of equities or without the lack of upside of fixed income and cash. The third way is to improve portfolio diversification without the drawbacks and high fees and the complexities of alternatives. So in this section of the presentation, I wanted to show performance against other real return managers and then look at performance against commonly used alternative managers as well. So here is the performance over 3 years, and you can see that the Real Return Fund over 2019 lagged other real return managers with higher equity weights. At least that was until the sell-off in 2020. Today, the fund has outperformed both higher and lower beta managers, which is incredibly pleasing to see. Interestingly, the Diversified Real Return Fund has had one of the lowest equity betas in its peer group, indicating its returns were not all driven by the direction of markets. Its beta also dropped during the sell-off, while other managers increased. It also has one of the lowest standard deviations or volatility measures of its peer groups. And both of these features combined has meant that it has suffered one of the shallowest drawdowns when markets sell off, not just in the recent period, but across other periods as well. Now, if you look at the performance versus the alternative managers, you can see again that performance has kept pace with the bulk of the managers, making it a very suitable core allocation in the alternatives portfolio. Again, its volatility is lower, in some cases significantly lower than other managers in the peer group. And its drawdown has been lower as well, with some of the alternative managers falling more than 20%. So how have we achieved these results? Well, I think of our role as being risk managers first and foremost and asset allocators second. I think it's important to think about what makes the fund different, and it really boils down to these 3 points. First of all, it's about being able to adjust the fund's allocations according to risk and opportunities. And most retirees, unfortunately, will stay invested in cash and bonds and will ultimately miss out on opportunities to buy equities and credit and property when they're cheap. Now, avoiding risk has never been more expensive today, and it's going to be very important to reset portfolios to take advantage of those opportunities to drive portfolio returns. Secondly, in order to do that, it's really important to have a comprehensive risk management strategy. And underpinning our strategy is diversification, value, and quality. And the third key point which differentiates the fund is that the fund can be used in different ways to solve different client problems. But the most important problem that we're trying to solve is to balance the sequencing and longevity risks for retirees. This next slide shows how the portfolio changes its allocations through the cycle. We're currently at the bottom right-hand side experiencing a bear market, and naturally the fund's weighting to return-seeking investments is lower than at other times. And at the moment we are selectively adding to this exposure. Downside protection has played a very important role in absorbing shocks, and we are rotating between the cheapest and most efficient downside protection strategies. Our allocation to diversifying opportunities is also quite high, but as the sell-off progresses, these exposures could be used to fund the purchase of equities and credit at attractive valuations. Then finally, inflation protection will be added back into the portfolio during the early stages of the recovery. The most likely inflation hedge will be to remove fixed income duration, given that bond yields are extraordinarily low. The main point on this slide is to highlight that the portfolio characteristics will change over time. At the moment, it is quite defensively positioned, but as market opportunities open up, we will increase the risk of the portfolio in pursuit of the CPI plus 5% objective. How do we know where we are in the cycle? Well, as we've discussed previously in the last webinar, there were very opportunities given valuations levels to make inflation plus 5% per annum safely, particularly in the credit and equity space. Here, the chart on the left-hand side shows where we were with Australian industrial ex-financial forward PE. This was at the highest level since the 1930s and was not a particularly attractive asset class at the time. But it wasn't just Australian equities that were expensive, it was also global equities, credit markets, listed property and listed infrastructure. One of the reasons the valuations got to this level was that bond yields were at all-time lows. Given the price of bonds is the inverse of the bond yield, this means that bond prices had never been higher. We also discussed the fragility of the US credit market, where corporate debt to GDP had never been higher, and the proportion of BBB securities in the investment grade category had ballooned to over 50%. A lot of the debt companies had raised had found its way back to the shareholders via buybacks, which meant that they had financially engineered EPS growth. And meanwhile, quarterly earnings growth had been in decline all of last year. At the end of the investment cycle, the real return fund is designed to look more like a conservative fund, which you can see here. We had about 29% invested in equities and had increased our exposure to diversifying opportunities such as market neutral equities in the pure equity alpha, and we held 1 year of duration. But in addition to duration, we also maintained portfolio hedges to protect on the downside. But what was also important was what we didn't hold, which made a big difference to portfolio returns in the most recent sell-off. We held no exposure to US credit, and we removed the last of our exposure to senior loans in late 2018. We also reduced our exposure to pure credit alpha, which is a mix of senior and subordinate debt. We reduced that by half in late 2019. We held no listed property in the portfolio and instead held a 5% allocation to unlisted property with a focus on industrial, in the industrial sector. And we held no listed or unlisted infrastructure and no listed or unlisted private equity. And each of these categories have sold off aggressively up until March. But in addition, we also had tactical positions which helped to protect on the downside. We had US dollar call options against both the Aussie dollar and the euro. And with the fall in the Aussie dollar, we were able to roll the strike on that Aussie dollar put to be able to lock in profits. We also held a 9% face value put options in the ASX and the S&P 500. And again, the sell-off in those markets allowed us to roll the strikes of those options to lock in profits. And as discussed before, when you roll the strike, all you're doing is selling an option which is strongly in the money and buying another option with the same maturity with a much lower strike price. That means that you're taking profits out of that particular position, but you still have downside protection if the market continues to decline. And as the equity market volatility picked up, we rotated the defence away from put options in equities to buying a 10% call option on the yen. And again, the yen appreciated from 110 to 102, and that gave us an opportunity to roll the strike on that option as well. And you can see an example on that on the next slide, which is just the February 28 put option on the S&P 500. We bought the option where the blue circle is on the left-hand side, and you can see that the market is shown in the grey bar. The S&P 500 began to decline, and you can see in the yellow dots that gave us an opportunity to roll the strike of that option. And the red circle is where the S&P 500 option expired, and we're able to lock in significant profits during the initial phase of the sell-off. On the next slide, the blue line shows the 3-month implied volatility of the S&P 500, and the yellow line shows the 3-month implied volatility of the US dollar Japanese yen position. And you can see that where we had put options on the S&P 500, they're represented in the blue dots, and you can see that implied volatility picked up significantly as the market sold off. And that's why we rotated our position to the much cheaper dollar yen position, which is represented in the green dot. So in terms of looking ahead, is now the time to increase risk? Well, we have increased risk in the portfolio selectively, but we're very aware of two main points. The first is it's very difficult to get a handle on how deep and prolonged this slowdown will be. And therefore, there is a great deal of uncertainty surrounding the impact on earnings growth, that a 30 to 40% decline in earnings growth is not unrealistic. And the second point is that markets have a propensity to move to extremes. And we have had a period of exuberance in markets when buying the dip was very well rewarded. So we could see a period of when investors move to a state of despair as investors see markets sell off again. Another reason to be cautious at this stage is that a number of defensive asset classes, such as government bonds, have been whistled away. Even gold and the US dollar have performed well. And so it's going to be very important to select cheaper hedges and adjust defences in the portfolio as those defensive asset classes lose their defensive characteristics. In thinking about where to from here, I've divided the final slide between what's likely and what's very uncertain, and then the portfolio implications. So what we believe is highly likely is that lockdowns are working, but it's not sustainable. and you can't stimulate an economy you're actively trying to shut down. So there is a huge tension between how long you're able to keep a lockdown in place and reduce the number of COVID-19 cases before the economy won't be able to withstand it any further. Now, there is going to be an improvement in COVID-19 testing and tracing, and that is going to assist reopening the economy greatly, because any new cases of the disease will be tracked down and treated quickly. But it seems that given the higher job uncertainty during this period and after this period, and given the high level of household debt, particularly in Australia, it's likely that precautionary savings are going to increase. And it also means that there is likely to be a higher unemployment rate on the other side of this crisis and take a while to work off to get back to levels that we enjoyed back in December of 2019. And in the very uncertain category, there are a number of different issues. The first is the depth and duration of the economic impact. The second is the profile of the economic recovery. Will it look like a V-shaped recovery? We highly doubt that. Is it going to be more of a W or an L-shaped recovery? That's certainly going to have market implications. The third issue is the timing of the vaccine. It still seems to be some time away, so we're going to have to deal with isolating and treating the disease through lockdowns and testing people. A second wave of infections following the reopening of the economy cannot be dismissed, and that was certainly the case during the Spanish flu. And then there are second-order impacts that we need to work through. For example, in Australia, it could be the decline in house prices and the working through of various excesses, including zombie companies, and whether they'll be able to survive during this period. And then there's portfolio implications. And I think it's important that people reduce their reliance exclusively on government bonds for downside protection. Government bond yields are very low, and if inflation is one of the byproducts of all the monetary and fiscal expansion that's going on, then government bonds may not be the right place to be. Portfolio liquidity will stay in focus. I think portfolio liquidity is incredibly important. One, to fund redemptions, but two, to also maintain control of your asset allocation. And maintaining control of your asset allocation will mean that you can take advantage of the opportunities that are likely to come up. I think fee efficiencies and considering the role of alternatives is also going to be important going forward. And active asset allocation and the diversification of active asset allocation decisions, and potentially away from the diversification of active stock selection, is going to be very, very important for portfolio outcomes. In the end, avoiding risk will invariably lead to low returns, particularly in this environment. And so the only way that you can generate returns is by owning that risk, but having embedded risk management. And that's going to be absolutely critical to protecting and growing wealth for retirees. Matt and I have very much appreciated the opportunity to talk to you at this extraordinary time. Please contact your BDM with any questions, and we'll be very happy to respond. We wish you and all your families a safe and happy Easter, most likely at home. Thank you very much.